This is a very basic setup that we have at Hedgeye. I'm not going to give away the model, but if I give you something like this, which is, let's call that, can we see that? Is that good? You guys see that? Oh, that's right. Damn it. How could I forget the moving monkey? If you're just staring at price, you got to start with that. I don't disagree that the price matters, obviously, but price volatility and volume are what really matter in the aggregate. So again, when you're seeing a market that's basically going up on volatility not changing, again, volatility, we call that a bullish trend. It has been since we started making that call in 2014. And volume's going down on the up moves, that's bad, okay? It's called a liquidity trap. And then you lose all of your returns for the summer in a day. One day. You can go back, like literally go back 3 months ago, and the S&P 500 is right where it was, okay? In one day, you lose it all because you didn't trade, you didn't sell high, you didn't think that we could ever go down again. Don't do that, okay? In as much as this would be very positive, by the way, if volume was accelerating on the up moves and it didn't look like that. So again, that's important. Volatility, measuring and mapping volatility, hugely important. Huge!
Any chance that the current bond carnage could be due to the Saudis pressuring / dumping U.S. Treasuries as in protest to Obama's decision to pass the 9/11 bill?
Wow, I have not heard that one, so thank you. Mm-hmm. I think it's really important to do a lot of meetings with people who know what they're doing, and I'll just take, I do trust that people are putting things in the queue that they actually think has some trustworthiness and truthness to it. So that could be it. I think that there's more likely that it's somebody really, really big that runs a lot of risk parity money that was selling. And you can guess who that would be. And I am certain that there was that going on. So there were sellings and resets. Just so that you know, this is a good time maybe to go to the board. Let's say something that looks like that, okay, VIX. For people that run risk parity funds, when the volatility of that asset class goes from bearish to bullish, in other words, the securities are going like this and down, they reset. Okay, there's a huge rules-based system on that, and quants, by the way. So you have both things going on at the same time. Risk parity saw a lot of volatility in what they thought were low beta assets, bonds, which eventually will be on a much longer term duration, which is what we do. And then you have quants that are purely, at this point of the game, I think it'd be hard pressed for you to not believe that price momentum matters. So we've seen a lot of price momentum break down on shorter term durations. What quants do is try to front run each other, because they're all using the same damn systems, by and large, not all of them. The good ones are using the good ones, I know. But then the risk parity setup is they're big sellers. They were big sellers, I think, driving. Watch something like, I don't know if you watch this, Darius, but you could see this in something like the physical gold market versus the gold miners, or ETFs that are related to precious metals and mining. Precious metals and mining stuff was looking like equity VIX. It was going like this. Whereas gold's volatility was like this. What does that mean? If you've been in the institutional game, which I have for a long time, that means that there's a lot of people being forced to make a lot of decisions in equities that are linked to certain expectations from a volatility perspective, and that's whipping people around. It's been a lot easier to be along this, which is the nice slow-moving waterbed of gold. Mm-hmm. Fly fishing. Not...
No, that's why water rafting.
Class 6 river rafting in West Virginia.
Oh, yeah.
Woo!
The good stuff.
The trade line for the 10-year bond, here, let's just do it. 10-year yield, trade line, 1.63%. Trend equals 2.03%. Tail equals 2.14%.
Yeah, we're a long ways away.
You're a long way from Kansas, and my name ain't Toto. Mm-hmm. If you're getting whipped around by this, join the club.
This is my own personal question. Going back to the last few...
And 1 second on this, because I just got 2 questions popped by institutional guys on this. This is a trigger, right? I'm using this to front run machines, or stay out of the way, of something that could naturally happen. That's why I keep saying 170, 171, 173 is where I want you to be buying bonds now, not 163. Okay, so again, that's a trigger line. We're trying to use it for proactively predictable behavior. People that are chasing 50-day moving monkey averages, for example, are freaked right out. They think bonds look like hell, just like they have every single time bond yields have had a rate fear shock. This has been a year now, okay? So you use this opportunistically and try to understand it. Also try to separate your fundamental view from the reality of that within the range. Okay, so the range on this, the range on this is currently 148 to 173. With this kind of smack in the middle of it. That's just a cocktail for short-term volatility. That's why the range on the 10-year bond yield has been widening as opposed to narrowing, because the volatility of the 10-year or anything long-duration bonds has widened in the last 2 weeks. So that's what I want to say about that. What question were you going to ask?
I was just going to ask. So going back to the previous sort of bond scare / sell-offs, the ones we keep getting, intermittently every so few months. What line of resistance has sort of they petered out at? Was it the trade line, the trend line, or the tail line? If you could sort of eyeball the chart.
All the bond, every single time, Josephine, I don't know if you have, like we've shown a longer term chart of the 10-year bond yield, one that I've doodled on, don't show the boring ones. Every single time we've seen volatility when you get jumps above the trade.
Gotcha.
Every time. And they've always failed at the trend. Gotcha. This one's not even close to the trend. I mean, bond yields have gone down so much this year that's why the trend is there. I mean, the 10-year bond yield started the year at 2.27%. I mean, some could argue that that's the trend. I mean, it crashed, right? I mean, on the lows, you're down 40% or 35, 40% from that level. From a trading perspective, all that looks like within a bearish trend was this. Goes down here, then it gets a bounce. There's probably a trade line in here somewhere, and it keeps going. And then, wham, back down again.
Gotcha.
And again, our catalyst for that wham back down again, which I don't think that Carl's going to be able to get the camera any lower. But if you are going to the all-time lows in bond yields, my call and our call has been for well over a year now that growth slowing is the catalyst for that. I understand that the new catalyst or the new fear is that Japanese government bond yields are going to go up and German bond yields are going to go up. That could happen. Then we're all screwed anyway, by the way, and I'm going to have to reset. But I'm operating with the high probability event that if the growth data continues to slow, the Fed is not going to raise rates, or if they do raise rates, the growth data is going to get actually slower, and they're going to have to go to dovish by the December meeting anyway. I'm the longest of long-term bond bulls. There is not one person, and I can take anybody to task at this point because we just lost Gunlack. There's nobody. There's not one person. Maybe I'm not really well known, and I don't want to be, but the reality is that there's not one person that's more bullish on growth slowing from a bond market perspective.
The question is, when something does, when something hits the top end of your risk range and you push the button and it moves higher, do you look to short it again or buy it if it's at the low end? And then, if that continues to happen, at what point do you get out of a position and decide to reevaluate it?
Yeah, I reevaluate every minute of the day. If I have a position in something, you know how many people that we compete against want me to be wrong on things every day, all day? I assure you that if I have a position on something, I think about it all day, every day, and I think about every single scenario that my analysts can throw at me, and most of those things are the counter thesis. So again, we think about where we could be wrong all day long, just to be clear on that. We have a lot of people here, a lot of thoughtful people with good process. That's what we do. So we're constantly evaluating. You can't see inside our minds, you're not here, but I can assure you, and maybe we'll put that up for grabs, a couple days just sitting with us. I mean, you'll see it and you'll respect it. But within the range, that's exactly what you do. I mean, at the low end of the risk range, if it's something that you like, I mean, if it's something that goes up, you sell some here, and if it goes back down to here, you buy it back there. I used to do it in thirds, okay? Thirds of my position. I wouldn't have 10 triple downs in a position. That's how I do it. So again, my max position, I'd go to here. And again, I'd only do that if the research supported it. I'd only go to max almost here in bonds. I did it literally all, for the last week and a half. I didn't come into this rate scare choke or chock full of bonds. No, that's not accurate. I actually cut my position significantly when bonds hit their all-time highs and bond yields hit their all-time lows. And I came back and I've been adding to it methodically. It's a process, and that's what you should really focus on. Back to the other thing that I was going to point out on how Trump on the throne and all that stuff, the velvety throne with the Bear Stearns guys. Okay, so to remind you, plus 3% is currently max for the U.S. economy. Josephine, show slide 11 in the current macro deck, if you will. Now, this is, so contextualizing that, so you could see if you were to take a line and go back to World War II, you could draw a straight line down of lower highs in the U.S. economy. Every cycle, when we say every cycle is lower and slower, that's what we mean. It's a secular problem. Yes, the 1990s were very good, but the most you can get right now in this U.S. economy, the new top might be 2.5%, but for now, the top end of this U.S. economic expansion, which was 86, 87 months, or at least that's where it is now, but the top was 3% on a year-over-year basis, okay? We've talked about this a lot, and I know that if you know this, and I repeat it every day and I remind you, again, brush your teeth, tap down the hair, get ready to go, wash your face, come down to here to 1%. That's where we're at on GDP right now, okay? The probability of that going to 4.5%, because Trump is the president, is 0, okay? 0. Because this is gravity, okay? The more likely scenario is actually that the economy, the probability of Trump rises because of this going down. This is, so as it goes towards, let's say it gets down to here to like 0.0%, and he becomes president. Well, at that point, it doesn't matter if, a raccoon was president. The reality is that, and maybe a raccoon is who we should consider as an independent candidate, because the probability once the economy's gone from here to here, accelerating, is at its highest point, okay? It going to 4.5% is Trump just basically going to his core. When he was really feeling good, sitting on the velvety throne in front of a bunch of raging Republicans who used to hate him. He's sitting there and he's just going to say what he can say to people who wouldn't know otherwise, and they're going to believe him. That's why he always starts out with, "Believe me."